Welcome back to the Banking on Digital Growth podcast. I'm your host, Derek Kraus. I'm joined today by Joe Colca, who is the founder of Forge Clarity. He has 26 years of experience in financial services with brands like Vanguard, Citi, and VyStar Credit Union. In this episode, we talk about the struggle of credit unions and banks to compete with digital-first players. Most people characterize this struggle as a technology problem, but Joe and I share a different opinion. It's less of a technology problem and primarily a strategy problem. Joe and I discuss how financial institutions can take the right steps strategically to successfully compete. Most importantly, the first step is to achieve strategic clarity to know where you need to go and why. You were telling me about the holidays. How was it? What'd you get up to for Christmas and New Year's?
Yeah, it was pretty low key. Our family was, my kids were home from school, which was my daughter was in college and my son was off in high school. So it was a lot of kind of hanging out with them. We're big Stranger Things fans.
Oh, really?
So
I haven't watched that, but I know some people that are fans that really like it.
Yeah, so we got into that, was Christmas Eve and New Year's Eve, kind of watching all those episodes. So that was kind of big on our side, and we're also fortunate that both sets of family are nearby. So my in-laws and my mom are within 15 minutes. So we got to see them both around holiday, Christmas, New Year's, and then my birthday in between. So it was good.
Oh, so when's your birthday?
I'm the 29th, 4 days after Christmas.
Okay. So did you grow up with, this is your present for Christmas and your birthday?
Apparently, I think that started off the way my parents said when I was very young, somewhere around the 2 or 3 age. I said something like, Christmas is for gifts and birthdays is for cash or something like that. So that was something I instituted at a really young age.
Okay, so you found a way to work that out, because I have a brother that he was born on January 1st, 2000. So I always know exactly how old he is to the day, but I think he's had that his whole life, where his birthday is so close to Christmas that he ends up just getting one gift, or whatever gifts he gets for Christmas. It's kind of also for his birthday. Although, to my parents' credit, they usually tried to make a point of celebrating his birthday too. But yeah, well, that's and you said your parents and your in-laws both live like 15 minutes away?
Yep. I mean, we moved down here 10 years ago, and up from the New York area, and it was kind of on a whim. I was moving with Citi at the time, and we would give it 2 years. About, I think at the 3-year mark, my parents started snowbirding here. Then about like the 5-year mark, my in-laws moved down. So we had a slow trickle of everyone kind of following us down, which made it nice. Because like when we lived in the New York area, like we were like the central hub. Everyone kind of came to our house, like parents and cousins and stuff like that. So my kids had grown up with that, and so moving here, it was being 15, 20-hour drive away, or a couple hour flight. It was just different. Some of the holidays were it was fun, it was nice, but they were isolated, right? So we ended up doing a lot of things to kind of give the kids like that feel of family, where would have a couple different laptops and iPads on the table, and we would FaceTime with different families.
Oh, that's cool. Yeah.
Folks the family for different events.
And remind me where you are now.
Jacksonville, Florida.
Okay. Yeah, that's right. That's very different from New York.
Very much so. Everything here is 20, 25 minutes, 25 miles. You have to drive. So it's still taking me even 10 years to this point, getting used to driving everywhere versus being able just to kind of walk to different places.
Yeah. Yeah, and so you were with. Last time we talked a bit about VyStar, and I know now you're doing Forge Clarity.
Yep.
And so, remind me where VyStar is located, and were you in New York when you were working with them, or give us, give us some background
So
on
VyStar,
chronology. geography?
Yeah, absolutely. So VyStar's here in Jacksonville, Florida.
Okay.
They're headquartered here. They are the second largest credit union in the state of Florida. So I joined them after about 14 years with Citi, of which I spent about 11 years with Citi in New
Mm,
York and the last three here in Jacksonville when I transferred down with Citi.
gotcha. Okay. And was VyStar the last thing that you did before Forge Clarity, or did you have some other things in between?
Yeah, so I can do a quick chronological order. My career started off actually in derivatives. Right at the beginning, I think as the derivative market kind of started, and it was to kind of date myself a little bit, is when the euro was coming out. So there was a lot of carry trade development for yen, dollar, and euro as that was kind of all coming together,
Hmm.
and was doing it on the behalf of like basically a family wealth office. It did that for about a year, moved my way into the Vanguard group in Malvern, Pennsylvania. And I spent about 3 years there working on various different things. Really, like the last 2.5 was in their internal consulting group called VUE, Vanguard and Matchful Excellence. So that was the model of like the GE, Lean Sigma, Human Sigma kind of combination that was kind of being brought into kind of like the services side outside of manufacturing.
Hmm.
Decided I want to get a little bit deeper in my kind of professional experience. I had zero business classes as an undergrad. I was all science and math.
Oh, what'd you study?
So I did a combination of chemical engineering and kinesiology.
Oh, interesting.
Yeah, I had an uncle at the time that worked for pre-Enron, but he was working for Arthur Andersen on the accounting side, and he was looking at the consulting side and saying, "Look, they're hiring a bunch of young kids, math and science majors, kind of into these roles." So I was kind of looking at, basically three different things at one point in time: physical therapist, a doctor, or consultant.
Okay.
And so I just focused on something that would kind of give me the best lay of the land from an optionality standpoint undergrad. And so it was a combination of the chemical engineering and then kinesiology kind of pieces. And then found myself into derivatives, then found myself into kind of Vanguard and kind of their internal consulting group. And then I went to took 2 years off, went to business school in DC, and then wound my way up at Citi in their leadership development group, and then just rotated across all aspects of the consumer group and kind of corporate strategic planning. Really ranging everything from financial planning, financial analysis, marketing analytics, marketing, program management, product management, and then did that all within kind of the credit card, retail bank, commercial business, and then kind of the corporate from a M&A standpoint. And then about halfway through my tenure, I moved into, we kind of had started having this centralized digital organization, that focused on basically the lines of businesses. So then my next 8 or so years was in some capacity of digital product, digital experience, digital analytics,
Mm,
going across North America and global, and got to a point where I really enjoyed what I was doing, but I wanted to, with Citi, you have law of large numbers, right? So you have all these opportunities to do these massive things, $10 million here, $20 million there. Then the organization makes like $15 billion that quarter. So like, but you're doing a lot. You couldn't feel like your impact didn't always feel like it made a big dent.
mm.
And I wanted to be a little bit closer to it. And that got me to looking at going smaller and found my way over to VyStar. So I spent about 6 years kind of at VyStar leading their digital transformation efforts. And then at the end of Q1 of last year, decided it was an opportunity to. I've been having this bug of looking and spending more time with fintechs, early stage startups, and kind of helping smaller credit unions. So I had this opportunity to kind of start out with Forge Clarity.
Yeah. So last time we talked quite a bit about the innovator's dilemma,
Mm-hmm.
and we'll recap that for the sake of people that are listening. And uh, I'm really interested in. So I think of that as, rather than being dogmatic about it, I do, I don't know that we need to necessarily accept the innovator's dilemma as the absolute truth that explains everything. However, I do think it identifies a pattern that appears to be true in many cases and in many industries, and the I guess to take it out of the abstract for anyone that's listened to the podcast consistently, this is actually a topic that I've talked about a lot. But so quick recap: The Innovator's Dilemma, written by Harvard professor Clayton Christensen. What he was trying to understand is, how do you have these industries that are very successful, and you have big players inside of these industries, or what he calls incumbents, that are these Goliath organizations that have been very successful, but then some excuse me, some new innovation comes along that changes the game. But the dilemma for these big organizations is that the innovation doesn't fit with their current business model. There's something about it that is fundamentally different from their current business model, and so they struggle to adapt to that new way of doing things, and so new entrants come in that eventually topple the incumbents, and it's a process that has sometimes been described as creative destruction. I believe it was the economist Joseph Schumpeter that coined that phrase, where in markets you have this constant cycle of, industries and companies rise, and then new innovation comes along that destroys the old and creates the new, and it ultimately leads to greater economic growth for everyone. But there's this destructive process that happens along the way. And so when I read The Innovator's Dilemma, I'm like, wow, this is it. It very well describes what's happening in the world of banking with both banks and credit unions, where the original model for banks and credit unions is branch-based and location-based. So if you want to interact with the credit union or bank, pre-internet, basically the only way to do that was to go and visit a branch, maybe a phone call for some things. Or I remember as a kid going through the drive-through with the tubes, I always thought that was cool and fun. Yep. But then the internet came along, and initially there was some online banking that was like desktop or laptop based, and then in 2011 there was the first mobile banking app, and basically the innovation that came along has made it so that while you can still go to a branch for banking, and some people still prefer that, it's no longer essential to go to a physical location, and more people are preferring that model, where you don't go to a physical location, you do everything remotely. I know for me personally, in 2007, when I went off to college, this is before mobile banking, and before I think even digital banking as a whole became what it is today, as big as it is and important as it is today. I went off to college, and my dad said, "Hey, there's a Wells Fargo branch on campus. Just go there and open an account." And at that point, at 18, I didn't know anything about banking or money management, so I'm like, yeah, I'm just going to do what Dad says to do. So I go there, open an account, and as a result of that, I remember in those earlier days when I was a neophyte to banking, I do remember going to the branch quite a bit, and also just time period wise, like, again, there weren't the same digital experience offerings then as there are now. It was a lot more common that's how you got things done. But then as I got older, I got more experience with it, and technology developed. I had those Wells Fargo accounts for a long time, just because switching your banking's a little bit of a pain, right? But eventually I was like, okay, I want to do envelope budgeting to provide like a better structure for my finances, and if I want to do that with Wells Fargo, they're going to charge me, I don't know, $5-10 per month for every individual account that I open. So that's not going to work for me. And then secondly, they're paying me like 0.01% on my savings account. It's just like crazy. So anyway, my point to all of this is I went on to look for something else, and another thing I don't think I'm the only one in the world like this. In fact, I know that just based on conversations with other people, and especially I think in my age group and younger, I was like, okay, I'm going to find a new credit union or bank to work with, but I'm going to find one that does not have any physical branches, because I know if they have physical branches, they're going to use it as a crutch at some point and ask me to go in. Versus if I pick one that doesn't have any branches, then they are forced to figure out a solution to deliver everything to me remotely, support me remotely. And that's what I want, because I don't like having to go to branches. It's just an inconvenience. Every time in the past I've had to go to a branch, I'm like, why? Why can't I just do this from wherever I am? So I ended up going with Ally Bank for my personal finances. I mean, like most people, I have other accounts other places too, but that's what you'd call my primary financial institution is Ally, and I've been very happy there just because they've got a great digital experience, and I never have to go to a branch, and I can do all of the envelope budgeting that I want to do, and they don't charge me per account. So that's I see that, and I through hundreds of conversations with credit unions and banks over the years, and this is where I'm really interested in talking about your experience with VyStar and your perspective on this. And people have different perspectives, so you don't have to agree totally with my perspective. But what in my personal experience and talking with lots of particularly marketers, but at credit unions and banks, but I've heard really sad stories about, like I'm thinking of one credit union in particular where there's a gentleman there in the marketing department that was a client of ours, and he said, Derek, we are literally dying as a credit union because we cannot attract the younger generation because we don't have the digital experience that younger generations expect. Mm-hmm. And our older members are getting old and literally dying, and are so like the average age of members of the credit union is just going up. They can't attract the younger audience. They're not, that organization's still around. They're not going to disappear overnight, but it's kind of like their fate is already, it's written on the wall, almost like their doom is sealed unless they do something dramatically different. But they find themselves in this situation where they're in the dilemma because they still have all of these members that expect the physical branch experience, that want it. I might be generalizing, but mostly older generations, and they have to invest all of that money and continue to run those operations, and that's money that they can't invest in the digital experience, and they're kind of trapped trying to have one foot in both worlds, and as a result they can't, like, the organization is unable to produce the digital experience that's needed to compete in that digital first world. So I want to hear, like, your thoughts about that dilemma and what you saw at VyStar, and you know what you're doing with Forged Clarity. Just tell me what you've seen, what you've observed with this, and just your overall perspective about it.
Yeah, so I think it's a fair point, and I think there's not a credit union, community bank, even big bank that I've spoken to that isn't figuring out where to invest, how to invest more, what needs to be better with the digital experience. I mean, I remember my days at Citi. I mean, we were a group, half a billion dollars of expense, right, in the digital organization, kind of supporting kind of North America and some global teams, and we had everything in the app. But every time we would do our NPS or customer surveys, people were asking for things that were already in the app, right? So just because we kept adding them in there, they were struggling to find it, right? So there's that perception that, like, the big banks have all the dollars, but their users are still struggling with kind of getting what they want out of it. Then I think you go down to, like, let's say the community bank and credit union space. I think every single credit union and community bank has done something to digital banking in the last 5, 6, 7, 8 years. Is it have they gone to a new provider like a Lumen, the spinoff from Valera? Have they upgraded with what they've had with a Q2, an Alchemy, or a Jack Henry, or Fiserv, right, to the next kind of generation? So I think they've all done something, right? But I think one of the things, especially as you go down the asset scale, is a lot of what your digital experience is going to be predicated off of is, especially on the smaller side, it's going to be, okay, here's this bucket, this offering that we have from you from one of the providers, and their goal is, from their standpoint, from a sustainability standpoint, a scalability piece, they kind of put out a vanilla thing that kind of matches across all these institutions at $1 billion. Hey, here's the things that are best, we think are best.
Yeah.
And there's very little customization on that, right?
Mm-hmm.
And then I think as you move up the asset scale, you see more and more kind of customizations. But I think there's a lot of this stuff looks at, okay, it started off looking at, what is Chase doing? What is Wells doing? What is Citi? What are some of the bigger banks doing? What are some, like, what was, Capital One Direct, their digital bank, what were they doing? What was Ally doing? And I think those are all great things as kind of understanding, okay, what's resonating, what could work. But then I think you also have things like, Uber is used all the time, right? The convenience piece is like, you could before you had to, like, hail down a taxi cab, right, in the major city. Now you can order on your phone and kind of wait for it, right?
Mm-hmm.
Amazon kind of throws things, kind of make it there easier. Netflix brings, hey, you watched these things in the past, here's similar things that are in there. So expectations have kind of changed quite a bit, and I think you fast forward things like TikTok and everything else, like now we're a bite-sized economy, right? 30-second, 60-second kind of pieces. So I think where there was this strategy of seamless or frictionless experiences, or slightly friction-based, because, like, if it's completely seamless, you kind of forget about it and you don't remember it, or you go the IKEA path where they purposely inject friction so you kind of remember it and kind of go through it. There's some of that balance they're trying to figure out. But I think people just want things to be easy. They want to be kind of fast and quick and kind of know it's there. And I think there's this perception then that the bigger organizations, like the big banks, are just going to be there, right? I think if you look at the millennial and the younger Gen X and kind of generations, they've gone through what? Financial crisis, right? Gone through a couple of these other, how many once in a lifetime events have happened in the last, like, 10 or 15 years. And you saw what happened to those big banks, and as bad as it was, they weren't allowed to kind of go under, right? So you had all that investment that kind of propped them up. So there's a little bit of that, like, okay, maybe there's just safety in size, right? And then there's okay, they'll have the budget to kind of get there. But I think if you look at it, there was something I read last week was in the last decade, I think the average age of the credit unions got up like 10 or 12 years. I think it was like in the mid to low 40s. Now it's in like the mid 50, low to mid 50s,
Mm.
right? Is like the average age. So investment has happened, right? A lot of cases for credit unions and community banks, but it's the perception piece. Like, while the investments happened, has it kept up with the expectations? So I think that's kind of the two parts of the equation. Yeah, you can keep investing, but have you invested that's met expectations, or have you just invested to get to the next level up,
Mm.
right? So I think that's kind of the trade-off and kind of figuring it out. I think the other thing too is this whole build by partner kind of continuum, right? What you need to look to do, and again, it's going to be asset scale dependent, but I think with credit unions and community banks, there's a lot more partnerships that happen, because they just don't have the budget that can kind of go around. So they lean on, let's say, the Jack Henrys or the Alchemies to help them kind of get there. Now you're seeing some other much stronger partners, like someone like a Clutch on the digital account opening, both for deposits and lending. So it's like you figure out what's the right path you want to take, and then, because I think what folks forget about, there's two parts of, if you go down the build part, there's two parts of that, right? Building it, getting it to launch, and then there's the managing it.
Mm-hmm.
Because managing is just as expensive, if not more so, than building the piece,
Mm.
right? And I think tied to that, you've got that whole project versus product kind of mindset, how you think about kind of your investments and the things you kind of take on. So it's a lot of, I feel for like a lot of credit unions, and I think there hasn't been a really, really big consolidation phase. Like you saw like in the late 80s, 90s, early 2000s, banking went through a tremendous consolidation phase. Is that going to happen with the credit unions in the smaller community banks, given how expensive things are? Cybersecurity risk continues to increase, right? Moving to cloud-based environments, which are basically table stakes for the larger organizations. How do you get a smaller organization to kind of shift to that path? And then and then the current flavors: AI, cryptocurrency, stable coins, tokenized deposits. What's going to be the best thing are you going to be able to kind of manage to? Because ultimately you have to stick true to who you are and what your members and who your members are, and being their fiduciary.
Yeah. So as you're talking through that, there's this question that is coming to my mind, and I'm gonna ask this first in, like, from the perspective of just how things have been for the last 10 to 15 years, where it's kind of like being branch based versus branchless.
Mm-hmm.
But I think we also need to talk about what's happening with AI, because I think there are still some doubters about AI, and some people still think that it's a fad. I think, based on my experience using AI every single day, and I've seen the like its capacity for increasing productivity. It's not a fad. But anyway, before we go there, so I guess my question, if you think about a credit union or a bank, just at a high level strategically. So, I mean, at the end of the day, the way that they exist and any business exists is you have to deliver a product or service that people want.
Yep.
Period. Like, if you don't do that, you fail. If you do that, you succeed. So, today, there are still lots of people that want physical branches. And so there's still a business model for that, for now. And I have heard, in having this conversation with lots of people, I've heard some people at credit unions or banks will say things, well, yeah, but you have these younger generations that are also visiting branches too. And I'm like, okay, but that, I think, first off, there are lots of people in the world of you'll find some people with any sort of preference, but also I think it might be I my part of my theory on that is it might be an age thing. Like I remember again when I was young and I didn't know stuff about banking and finance. I was kind of like nervous about it because I was like worried about doing something wrong or not knowing how things worked, and I think there might be more of an inclination there to go visit somewhere physically and talk to people in person, and maybe that'll be an ongoing trend going into the future. I'm not sure, but ultimately, what I'm getting at is you've got the branch model. Some people still like that, but I don't think most people would argue with saying the clear trend is digital, is like where the future is going. So I'll call the branchless model. So branch-based versus branchless. My question is, can you successfully be both or offer both models? And I think we could break it down at maybe different levels. I think if you're Chase, maybe you can, just because of the amount of resources. And like I have a Chase credit card, and that's like the only thing I have with them. So I'm not using all of their digital services all the time. So I can't give an accurate assessment of their overall digital experience. And the same with Wells Fargo. I still have a Wells Fargo credit card, even though I don't use them for anything else at this point. So I occasionally am logging into their mobile banking apps to like pay off a credit card. And both of those experiences are fine for what I'm trying to accomplish. It's very simple. But maybe if you have massive amount of resources, maybe you can be both successfully, at least for now. Maybe at some point in the future that, like with how rapidly technology continues to change, especially with AI, maybe that won't be true in the future. But if you're a credit union or community bank, can you successfully deliver on both and at a high level? And I mean, like can your branchless experience be on par with fintech while also maintaining the branch-based experience? I have an opinion on that. I guess I'll just tell you my opinion, but feel free to disagree. I don't think they can. I think that's what they're trying to do, and not being successful at. They're producing digital experiences that are subpar. Like they're not on the level with fintech. And so I want to know what you think about that question. Can they successfully deliver both models at a high level? And I'm interested in hearing your experience with that at VyStar, because I know like it seems like that's what VyStar is trying to do, and they, like, you guys did produce a very good digital experience relative to other credit unions. Curious if you feel like it was on par with fintech. So I just hit you with multiple questions there. Maybe, yeah. But yeah, maybe let's start with: do you feel like it's possible for most institutions to like deliver at a high level with both models being both branch-based and branchless?
If I look at digital in this progression, and I would say 15 of my 17 years in the digital banking kind of space and digital transformation space, it was to get that digital channel, first internet, then the mobile app, on par to what a contact center or branch-based experience was. I mean, we went through a period at Citi. We had basically a 2-year period, and we all called it internally. We called it the feature tsunami, right? Because like we did a parallel path. Okay, branch was the, quote unquote the gold standard. All right, here's all the things you could do in the branch, which was basically everything.
Mm-hmm.
All right, then the phone could do about 70% or 75% of the branch.
Hmm.
Online banking could do 66% of the branch. And then basically you got all the way down to the mobile app, and it was like 25% could be done in the mobile app.
Hmm.
And so our big thing was, okay, well, we needed to be, this concept of meeting the person where they're at, right? And you've got a wide swath of folks, you know, across demographics, across age, and sometimes age didn't even play a part of it, of who wanted what experience.
Hmm.
And it kind of depended on what experience they needed based on the thing they were looking to do. And so we spent a tremendous amount of investment on getting mobile to match online and online to be 85% of branch, right? Because there's some like with safety deposit boxes you couldn't do in a digital app, right?
Sure. Yeah.
But you could now with some advantage you could do something similar, to that. But I think you kind of pull out the things you want, and so that was our big focus. And that was one of the things when I got the VyStar, when you looked at like kind of what our mobile app was not nearly as functional as the online piece.
Hmm.
The online piece was closer than it was when I started at Citi, but it still had a gap between kind of what the branch could do, and then actually the contact center was more closer to the mobile app. They were more limited in what they could do. And so our big piece was, okay, well, it's kind of like, jumping the shark was, okay, it's easy for us to kind of get out there with the partners that we have, both, web and mobile. And we spent a significant investment on the mobile side to get that to match kind of the piece. Because like VyStar's core piece was, we had and if you looked at like our surveys and everything, we had an incredibly strong presence from our members. Like our in-branch service was fantastic. Our phone service was really good. Our digital service, not so much. So our biggest thing was getting it to feel our digital to feel a little bit more like the in-person piece, so they could be kind of happy kind of with where they're at. And so, but now it's kind of shifting where the expectations are, I need to do what I want when I want, right?
Mm-hmm.
And so is it a digital channel? Is it a chatbot? Is it an IVR? Is it a contact center with a person? Is it visiting a branch with a person? And so now these are all of the avenues that basically consume kind of what you offer to your customer base. And you got to so digital now is native, right? My son doesn't know a world without the iPhone.
Right. Yeah.
Like he's grown up in a touchscreen world. So now we've got this aspect of digital natives that's all they know,
Mm-hmm.
right? How whether they consume, but you still have different segments trying to figure out how you want to go about it. To me, it comes back to how strong was your strategy and how good are you prioritizing the things you need to do? Because if you're going to say, okay, you know what, here's all the things we're going to do, and I'm going to take that piece of bread, and I'm going to take that knife with peanut butter on it and just spread it across 9-10 pieces of bread all at the same time. So everything gets a little bit of a coat. So you're making small drops, but you're not making anything truly impactful.
Right. Yeah. Yeah, I need more peanut butter than that.
100%. I think one thing you see on the credit union side, and it started off with the Fiservs and the FISs and the Jack Henrys. They leaned on those providers from the core perspective. Then that branched out to payments and a digital banking. So there's already a strong partnership model, I think, within the credit union space. And I'm going to speak to the credit union side because I know that much better than the community bank. But I know its similarities. And that's already kind of taken its next step onto the fintech side of things. And so there's a really strong partnership that credit unions see with fintechs, right? It started off with TrueStage, right? And then now you have the Circle Fund, which is kind of the consortium of credit unions kind of brought together. NBC kind of was in there. So there's this aspect where a lot of credit unions come together, and the fintechs all kind of come together. And so can they compete 100%? But I think it does need to get back to, are you really thoughtful with your strategy? Are you trying to do the right things at the right time versus kind of who your members are and who you are relative to kind of what some of the table stakes are in the space? The one challenge is right now, there's a phenomenal number of fintechs out there solving all kinds of different, incredible needs for credit unions. One of the challenges is getting that, okay, how to take 6, 7, 8, 9, 10 credit union or fintechs, stitch them all together so now it feels like a holistic experience to the end user, right? one of the things that was I learned this at Citi and kind of carried it over to VyStar is we, the organization, think about our digital app, our mobile app to such a degree that our users don't think about it the same way that we do.
Yeah.
How important it is in their life, right? You know, we used to have conversations of like, oh, our banking app needs to be the Fitbit. How they think about their Fitbit on a day-to-day basis. Really, in the end, people are like, okay, I want how much money do I have, right? And especially if you're on like the lower income scale, like, how much money do I have to spend today, right?
Mm-hmm.
Can I pay my bills? Is it easy to pay my bills? Can I get my money kind of quickly, right? There's some basic things that need to be done super simple that I think some have done well, a lot haven't, right? I think it started off with like the providers. So there was a provider for bill pay. Then there's a provider for like A to A external transfers. Then there's a provider for, for whatever type of P2P you're looking to use. Then you've got so you have your branded P2P via Zelle. Then you got your Venmos, which are kind of off book, right? And so you've got all these different pieces. And so I think just trying to figure out what's the right path to take and how you're going to bring it all together. I think that's the biggest challenge because there are some fantastic fintech partners that will say, okay, how do I say XYZ Credit Union compares to say a Chime, right? There's fintech partners that can make you feel that way and to your end user. But now, are you willing to take a step back and look at how your workflows kind of truly operate and manage? What things are you willing to take? What things were you willing to take a little bit more risk on than you're normally kind of comfortable with? And then I think one of the other challenge in there is that like the chimes have slightly different regulatory focus than, let's say, some of the fiduciary aspects of a bank or a credit union. So there are some hurdles, but there's still some ways for it to be significantly better. And so that's why I think you see partners like a Clutch, like I mentioned before, like they're coming to market and they're probably the most chime like let's say from an account opening standpoint,
Yeah.
in the space, and you're seeing why they're getting a tremendous amount of traction, right? With the credit union partners and community bank partners.
Mm-hmm.
The other thing I would say in all this is, no matter which iteration or transformation generation we've been in, is it digital banking, is it personalization, AI now, RPA? To me, like the one of the things that's super important is this whole plumbing and sewer system aspect of the organization, specifically the data. Like, how strong is the data? How well connected is the data? Because like if that's not in a good spot, it's going to be incredibly hard to bring forward kind of some of these really good experiences. Like I've seen credit unions that have really good experiences, but then their data is kind of crappy, and so they're offering me an offer for a product I already have.
Right. Yeah, I think I think what you're saying is like the technology's there to make those digital experiences you want to make, and I think it's I think credit union, and I'll just say credit unions because that's primarily credit unions, community banks. I don't think it's as much of a technology problem as it is a strategy problem.
Mm-hmm.
Because, like you were saying, like the technology is available, but the organization, because you were talking about, you've got all these different fintechs and services, and you got to stitch them together to create a cohesive experience. Well, in my company, we do a lot of software development. That's kind of primarily what we do, whether it's custom software at a website for an individual institution, or different software applications that we build. And anyone that builds software will tell you that you don't build it all from scratch. You're using all sorts of different services, and you're stitching them all together in a seamless way. But to do that requires I'll say tech people So you need developers, you need people that are experts in digital experience. And in my experience working with credit unions and community banks, primarily credit unions, they don't have those people on staff. Most of them don't. There are no developers on staff. They're, even when you get into a little more like slightly more technical for digital user experience, not even like software development, just like analytics or like user experience design.
Yep.
Most of them don't have that, and so that it's like that. Those skill sets, that thinking, those capabilities are not in the organizations. Anything they need for that, they're relying on third parties, and I feel like that can only get you so far if those capabilities aren't internalized. But the whole organization has been built around the branch-based model and optimized for that for decades, and then digital is still, even though it's been around for decades now, much fewer decades than the branch-based model has been around. So it seems to me like they're still primarily branch-based institutions. They're trying to bolt on the digital experience by just buying it from others for the most part, and not having the ability to stitch it all together, and just ends up with a subpar experience. So that's part of the reason I find in the Innovator's dilemma, Christensen, he said, okay, when you're facing this dilemma, and I think just real simply, the dilemma for credit unions and banks is you still have people who want the branches. So if you shut those down and go totally digital, it feels like suicide, because you got a lot of members and customers that still want the branches, and a lot of them are in the older generations that have more money than the younger generations. So the idea of just shutting all of your branches, firing all of your people, replacing them with tech people, and just going fully digital, like, who's going to go for that? Very, very, very few, because it's like feels like suicide. It's extremely difficult change, and that's why I think they're kind of stuck trying to straddle both. So I find it really interesting in the Innovator's dilemma when Clayton Christensen was trying to find out, well, what models work, and he talks about some like organizations can be successful at completely letting go of the old, shutting it down, and transforming to the new thing, but it's so difficult and so painful that most never make the leap, and those that do it, it like almost kills them. And instead, he was searching for what is the most successful model then. And again, I don't think we need to talk about it in a dogmatic way, or even that. I don't think he would be dogmatic about it. He's just looking for what's the most successful pattern. And there could be other patterns that work for individual organizations for adopting the new innovation, but what works most of the time? And he pointed to launching spinoffs. So we talked about this last time. So, and want to hear your thoughts about it. And I guess and I should probably, for everyone listening, if you haven't listened to a past episode about this, what I mean by a spinoff is you've got the parent organization. Let's call it a branch-based credit union. They recognize that they're not going to be able to straddle that model and the branchless model effectively. So instead of trying to do that, they launch a separate brand. It's like a separate entity that can operate independently from the mothership and be a totally branchless institution, like a digital only bank. And I guess the theory there would be that actually is freeing to the parent organization, because they no longer have to try to be that. They can focus on being the branch-based institution and serving people that want branches even more effectively, because they're no longer trying to like you were saying, they're not spreading the peanut butter too thin. And then anyone that wants digital, they're directing them and to that digital spinoff, and of course that spinoff would be operating independently to try and grow itself as well. And I think that's a really interesting strategy, and I'm seeing some of that. It seems like it's still young. It's hard to say definitively, like, yep, that is the way. But there are examples of that with, like, MSU FCU is one of the best examples, where they've launched 3 different spin-offs: Alumnify, Collegiate, and Pillar, that do specific things. And there's another one, I'm trying to remember the parent organization, but they launched Hustle, which is Hustle without an E on the end. Yep. Which is it's banking for freelancers. Yep. And then there's Roger Bank, yeah, and who's the CEO? Was it Citizens Bank of Edmonds that launched Roger Bank? And is it Jill?
Yep.
Yeah. What's her last name? Forgot her. Castilla, yeah. I saw she did a post, I think at the end of this last year, talking about how much growth they've seen with Roger Bank. And it just seems to me, while it's not far enough down the road to definitively say, yeah, that's what everyone should be doing as far as the results yet, strategically and logically, it like clicks for me. And I think there are, like, if I were a CEO at a credit union or bank, honestly, like, that would be the strategy I would be pursuing, because even if it's not 100% clear, you also can't wait. I don't think you can wait until it's 100% clear, because you might be dead by then. So tell me your thoughts on that strategy, that model. And
yeah, so I think it's a couple pieces, and I think it comes down to how well your strategy is thought out and how well it's aligned to what is you're trying to accomplish, kind of what is it your members need, what are the things that are baseline that we need to kind of have in place, and what are the enablers to kind of get into there, right? And yeah, they kind of going back to one example of, like, hey, can you really do all these different things internally if you don't have the resources? And it's probably an 80-20 model, right? Where 80% of it's probably going to be an outsourced partner, as an example, that you're working in, and then you keep that 20% of, let's say, the thought capital internally. So, like, we start seeing more like principal type roles, right? So someone who owns that strategy, let's say for digital account, or just say account opening, and how do you do it digitally in a branch, and making sure it's kind of done well. That's driving that strategy, and then it's working with its partners, right? Then you have, let's say, a technical architect and some of those other folks within the organization. And then there's a couple things you do decide, like, you know what, we are going to have a complete team of developers, all the way through, because this is something that's, kind of what we deemed as our core. But you need a really, really tight strategy, and you need to be in the product mindset versus the project mindset, right?
Yeah.
This project, start, stop, products, kind of ongoing enhancements. And I think this is where this slides in well. And on one hand, this is where credit unions are really, if you take a step back, they're very well positioned to take advantage of the strategy through the whole QSO model, right?
Yeah.
when I when I joined VyStar in 2018, I had no idea what a QSO was, right? But I had spent my time at Citi. I had worked a lot with Citi Ventures. They were investing in different kind of startups at different stages, and they would bring different things to us and say like, hey, can you pilot something? Can you think about like what problems you have? And they would kind of go out to the market and kind of come back. Credit unions were trying to get into that. There's a couple of things that were moving in that space, but it was really hard to invest into, let's say, a fintech because there's rules, right? Because the thing when you invested in something, it had to be primarily kind of credit union focused, and the
Right.
rules were vague on what exactly did that mean. And then but you already had QSOs, right? So credit unions would stand up QSOs for their investment division. You had some credit unions that were in kind of dead zone areas where there wasn't a whole lot of coverage. So they would start a QSO for armored trucks, so for cash delivery. So you had this model of credit unions kind of tapping into that QSO kind of piece, one to help themselves and to help other credit unions,
Hmm.
right? And then in 2018, 2019, you have this shift of the QSO from that standpoint to now, okay, here we set up a separate business. Here's how we kind of we oriented a legal entity that's still serving us, and now it shifted to okay, how do we kind of participate more and kind of into this space like fintechs? And we worked with Payveris at the time. We had to work on their craft and their QSO, and we were one of like their original investors on that kind of QSO. So there's a very strong process here for credit unions to really tap into. The ones we were talking about from like this, separate entity kind of stand up. Gisa Credit Union's also in there. They've got a few different ones. I think they have a healthcare one. They've got a couple other different spin-off banks.
Hmm.
Nimbus is kind of at the core of that.
Yes.
They're
Yeah.
helping those institutions. People's Bank is another great example in Connecticut. They had launched Zinlo, which
Yeah.
was kind of their digital bank, and that was kind of their pilot. And they actually, a few years later, moved their entire organization to that tech stack, right? With larger to that tech stack. So you have that kind of piece there. So I think it comes down to okay, I'll make it up. Maybe it's $1.5 million, right, to kind of spin up like that separate organization, which is depending on the size of the credit you are, could be it's a decent chunk.
Yeah.
But then on top of that, you're probably talking about let's say another dollar for dollar of okay, what's the marketing? What's the focus we need to kind of do with this? Because this isn't like was a field of dreams. Build it, they will come. You've got to build the thing, and then you have to market to it.
Right.
But I think it's a really, really strong model for some of the different things. Like, okay, if we don't want to upset our member base that we've grown with, who really love the branches, how do we go to, try this kind of standalone, bank or credit union and attract, a different set as well as pilot new ideas,
Right.
right?
Yeah.
Are the things that are great here, how do we kind of migrate them over? And I think so. Michigan State's doing this on kind of really two examples, right? They've got the three credit unions that you kind of highlighted. They also have Resita Group, right? That they're looking to kind of as they tap into the kind of credit union space where it's like their own kind of like it's part circle, part partnership, part working on things, and incubator. Like they're one of the few that I think that has something like that set up, and maybe another one or two. That's the one I see quite a bit. So they're having a lot of success of like, okay, how do we think about today, but then also how do we think about kind of the future based on the bets that we will take?
Yeah. And I think then about that model and about the future going forward, and I can't help but think about what's going on with AI. And I feel like we could spend another hour talking about that. But I see a possibility where, so you've got the branch-based model, which is being disrupted by the branchless model, and now I think there's a very real possibility of an AI-first model disrupting the it's not, I mean, it would still be branchless, but you've got all of these digital banks that are built around having an app that is UI, user interface, UI based. And so what that means is like when a software developer is making it, or designer is designing it, they're designing for specific functionality, and they're building specific functionality. And if you want to do something in the app, well, in order to accomplish that, the designers and developers had to have the foresight that that's something that you wanted to accomplish and offer you that feature and put it into the app. Where AI changes the game is it can do things that no one ever, the developer of the app never foresaw. It can write its own code. It can do its own functions, and just because you have a good UI based app doesn't mean that it's set up for the AI world. And it's too early to know exactly how this is going to develop, but I think there's a very good chance that the next banking app will be ChatGPT, where what you're doing is you're making a ChatGPT app that lives inside of ChatGPT, and then people come there and they can, they've got an interface. They can see their balances. They can make transfers. They can open new accounts, but with the power of AI behind them. And that's another whole topic to talk about. So maybe we'll have to leave that for another time, because I do, in the last few minutes here, I want to talk about Forge Clarity and what you're doing with that. So I know you told me a bit about it before, but yeah, maybe just give me a recap on Forge Clarity and what you're doing with that.
Yeah, I've spent my career, and I've been making this progressively step kind of to smaller. I started off at Vanguard, 8, 9, 10 trillion kind of. Then I went to Citi, you go to 2 trillion, and then you get VyStar was 8 billion, and about 14, 15 billion when I left. And kind of, for me, it's been kind of getting closer to the impact each time, to the impact and kind of the opportunity to kind of make a change.
Yeah.
And I've had an opportunity through my career, and I've been very fortunate to see so many different things. I've got to work on North America-based things, got to work on delivering things globally, so in Mexico and Asia, Latin America, Europe. So Citi kind of gave me an opportunity from a global scale to see different things, and then I was able to kind of take that into VyStar on a very localized level, right? We thought a lot about the digital strategy. How do you blend physical and digital together, right? I think the thing that's kind of consistent in all of this is modernization is challenging, right? And there's a lot of chaos within there. Like, I go through my LinkedIn feed, and it's like, okay, I got to be doing stablecoin, I got to be doing tokenized deposit, I got to do AI here, and here. And so there's a bombarding amount of things that, like, okay, here's these all be the things in my strategy. How do you kind of calm that noise? So a lot of like what I've been thinking about and focusing on is bring that clarity and calm to the chaos of modernization, right? And I've really liked this intersection of fintech and credit unions. It kind of, based on my time at VyStar, I got to sit in a couple of different QSO boards that we invested in and kind of see where they were going. And there's a really strong partnership between fintechs and credit unions. So I kind of spend my time about 50-50 right now, where I work with probably Series A and earlier fintechs and startups, talking about product market fit, positioning for the credit union space, kind of focus on that aspect of it. And then kind of sitting with kind of credit unions and talking about, okay, what are your challenges, right? And how do we kind of think about things? Because, for me, strategy comes down to, probably like 5 lenses that I think about this, right? Is what do our customers or members want or need, right? What are the table stakes to operate today and kind of in the future? What is our mission? What is the mission that we stand for, and what's our strategy kind of that sits around that? How do we want to think about the balance of managing the operations versus innovating around the operations, right? Because there is a push-pull on those kind of 2 pieces. The other part too is being honest. Are we good at change, right? So I kind of use those kind of 5 kind of areas to kind of start off with. and it's different for every institution, kind of where we need to be. It's like stable coins is a conversation we talk a lot about with, right? So if you're comfortable with experimentation, right now, do you want, XYZ Credit Union, do you want to issue your own coin? Probably not. But do you want to partner with, let's say, an Uphold or a Circle that you can at least now offer that ability to kind of hold and trade? That's probably the best bet for you, right? Like where you kind of want to go. If you have more of a commercial arm, there are some things you want to have. You maybe want to move upstream, kind of from that strategy, kind of what you want to, accomplish. But it comes down to kind of what your strategy is. So I try to spend time on kind of really kind of help understanding kind of what the problems are. Because part of it is like we said this earlier, right? Technology is only one part of this, right? How we operate is how we operate and how we think is another, and then really what legacy things are we holding on to in the end that are kind of preventing us from change? There's a lot that kind of goes into that. The other part too is communication is critical. I think a lot of times, you have these big kickoffs, big announcements, a couple updates here and there, but it's I had a CEO that I worked for at Citi, and his big thing all the time was repetition. Like he repeated the same 3 talking points ad nauseum. He's like, I gauge this based off of when I get sick of hearing myself talk is when I know I'm starting to have resonance, right? That's when saturation.
Yeah,
that's when your saturation starts, and then when people start reciting it back to you, now it's taking hold and it's kind of moving forward. So this whole aspect of change management and communication, usually it's like, hey, we've got the right ideas, or we have a couple of things that we're kind of stalled on the delivery side of it. A lot of it, to me, some of the biggest pieces to getting these all right back on track comes down to communication and expectations.
So most of the Digital Growth Institute audience for this podcast are credit unions and banks. If you were to recommend one action that they should take as a result of this conversation and your experience with what you're doing in Forge Clarity, what would be that one thing that you'd recommend?
I would say as a leadership team, are we truly clear on our strategy? What is we're trying to accomplish, and why? And why do we want to do it? I think there's aspects where there's a clear strategy, but the whys aren't completely clear. Or is our strategy a series of a bunch of shiny objects, but not really kind of tied to something? I think getting super honest, with as a leadership team and with each other is, does our strategy make sense? Do our employees truly understand our strategy? And do our members actually feel the effects of us kind of implementing our strategy? I think kind of starting there gives you some opportunities to figure out kind of where some of your gaps are to focus. Because really at the end of the day, if you think about an organization, there's probably 3 to 5 main priorities max that they could kind of focus on a given day in a given year. And so how do you kind of get really, really good at that? And then the next layer down is, all right, how are we going to balance the managing our operations and innovating? I think where I've seen this work really well is where you blend those 2 things together. As an example, like, hey, we know growing membership is something super important to us. Well, we know we gotta manage the, let's say, account opening process on a day-to-day basis. That's kind of what we have to do. Is there opportunities for us to innovate around that piece there? There's an opportunity where you can kind of blend those 2 kind of focuses together. So now it keeps the organization moving forward. It brings impact together, and you're still kind of growing the bottom line, which allows you to give back to your members and focus on kind of the next important thing for them.
So strategic clarity for the leadership team. Mm-hmm. And that aligns with one of the things that I've learned, and I believe from running my own business for the last 10, 11 years, is it's the big strategic decisions that make the biggest impact. And so I appreciate you sharing that, and thanks for coming on the show. It's been fun to talk again. And
absolutely, my pleasure.
Yeah, great to have you.
Appreciate it, Eric.